understand that there is no list of adjustments that the companies can use. However, what are the typical adjustments that draw the attention of tax authorities? So another good question. So while there isn't a definitive list of adjustments that companies are required to use, there are several common types of adjustments that frequently draw attention. Let's start with working capital adjustments. These adjustments are made to account for differences in accounts receivable, accounts payable, and inventory levels between the tested party and comparable companies. So the idea here is to neutralize the impact of working capital policies on profitability, ensuring a fairer comparison. However, tax authorities often dive deeply into these adjustments, questioning the methodology and whether they truly improve comparability. Next, we have risk adjustment, which address differences in risk profiles. So as an example here, a tested party operating with limited risk might need adjustment when being compared to full risk entities. Risk adjustments can become contentious because quantifying risk and its financial impact can be quite subjective. So here, tax authorities often challenge whether such adjustments are justified and supported by robust evidence. Okay. Another adjustment that frequently arises on the lists of tax authorities is the capacity utilization adjustment. Imagine here that a manufacturing company operating at a 50% capacity due to a downturn being compared to peers operating at full capacity. So that's just an example of that. In this case, adjustments are made to reflect the lower utilization. The adjustments, though logical, attract scrutiny because they can significantly alter profit margins, and authorities want to ensure that they are applied consistently and accurately. And obviously, if you can provide the evidence or the proof that you're running at 50% capacity, then it makes it easy. But it's easy to see why revenue services would automatically be attracted to capacity utilization adjustments. All right, then accounting differences also require adjustments. So for example, here, if comparables use different depreciation methods or inventory valuation techniques, adjustments must align these accounting practices. So here, tax authorities typically look closely at these to ensure they are reasonable and don't skew the analysis. Then there are adjustments for non-recurring and extraordinary items. Here we can think of restructuring costs and lawsuit settlements. These are often removed to normalize financial results, but the challenge lies in defining what qualifies as non-recurring. So authorities are wary of companies using this as an opportunity to exclude expenses that should legitimately remain part of the analysis. Okay. We also have foreign exchange adjustments, which become relevant in cross-border companies, which obviously we're dealing with mostly here. Exchange rate fluctuations can significantly impact profitability, especially for companies operating in volatile currency environments. So while Forex adjustments are widely accepted, they must be consistently applied and supported by the proper data. Another area that attracts attention is adjustments for geographical differences. So markets differ in purchasing power, competitive conditions, and other factors, and adjustments are sometimes needed to reflect these differences. So tax authorities are meticulous in requiring evidence to justify such claim, and they will often rely on market data, local market data for verification. Okay. Adjustments might also be necessary for functional or asset differences. For instance, if the tested party and comparables have varying levels of intangible assets or capital employed, adjustments ensure a level playing field. So this is particularly relevant in methods like the transactional profit split or the resale price method, and authorities focus on the methodology used to make these adjustments. We also have adjustments related to comparables. These come into play when financial data for comparables are incomplete or when reporting periods don't align perfectly. So tax authorities typically investigate whether the underlying comparables were robustly selected in the first place before even evaluating the adjustments made to them. Lastly, adjustments for royalty and licensing payments often appear in industries heavily reliant on intellectual property. When intra-group royalties or license fees distort margins, adjustments can align them with the arm's length principle. These adjustments, however, come under scrutiny due to their direct impact on taxable income. So now with all these types of adjustments, tax authorities share a few common concerns. Firstly, they want to see transparency, whether the rationale or methodology behind adjustments are clearly documented. Secondly, they look for consistency. Are similar adjustments being applied across related transactions and reporting periods? Thirdly, they demand strong documentation to justify the adjustments, including supporting data and calculations. And then finally, they assess whether the methodology used aligns with the OECD guidelines and local regulations. So for companies, the key to navigating the scrutiny is preparation. Robust documentation supported by contemporaneous data and applied consistently can make a significant difference. Proactively managing these adjustments and assuring that they are not only justified but also well communicated in your transfer documentation is essential to avoiding disputes. So concluding this question, while adjustments are a necessary tool for achieving comparability and comparability in transfer pricing, they must be approached with care. They're not merely technical calculations, but strategic decisions that can withstand the close examination of tax authorities. By being thorough, transparent, and consistent, companies can ensure that these adjustments align with the arm's length principle and are defensible in an audit.